on a touch-tone phone. To withdraw your question, please press star, then 2. Please note this event is being recorded. I would like now to turn the conference over to Mr. Al Petrie of Investor Relations Coordinator. Please go ahead.
Thank you, operator, and good morning, everyone. We appreciate your interest in Ring Energy. We'll begin our call with comments from Paul McKinney, our Chairman of the Board and CEO, who will provide an overview of key matters for the second quarter of 2026. We will then turn the call over to Sonu Johl, Ring Energy's Executive VP, Chief Financial Officer, and Treasurer, who will review our financial results. Paul will then return with some closing comments before we open up the call for questions. Joining us on the call today are James Parr, Executive VP and Chief Exploration Officer, Alex Dyes, Executive VP and Chief Operations Officer, and Shawn Young, Senior VP of Operations. During the Q&A session, we ask you to limit your questions to one and a follow-up. You're welcome to re-enter the queue later with additional questions. I would also note that we have posted an updated corporate presentation on our website. During the course of this conference call, the company will be making forward-looking statements within the meaning of federal securities laws. Investors are cautioned that forward-looking statements are not guarantees of future performance, and those actual results or developments may differ materially from those projected in the forward-looking statements. Finally, the company can give no assurance that such forward-looking statements will prove to be correct. Ring Energy disclaims any intention or obligation to update or revise any forward-looking statements, whether as a result of new information, future events, or otherwise. Accordingly, you should not place undue reliance on forward-looking statements. These and other risks are described in yesterday's press release and in our filings with the SEC. These documents can be found in the Investors section of our website, located at www.ringenergy.com. Should one or more of these risks materialize, or should underlying assumptions prove incorrect, actual results may vary materially. This conference call also includes references to certain non-GAAP financial measures. Reconciliations of these non-GAAP financial measures to the most directly comparable measure under GAAP are contained in yesterday's earnings release. Finally, as a reminder, this conference call is being recorded, and I would now like to turn the call over to Paul McKinney, our Chairman and CEO.
Thank you, Al, and good morning, everyone, and thank you for joining us. Before discussing the quarter, I'd like to spend a moment on the broader commodity backdrop, because it continues to influence how we think about capital allocation, spending levels, and long-term value creation. My view remains that the current market continues to underestimate the impact of long-term global oil fundamentals that are likely to continue influencing crude oil prices long after the current crisis involving Iran and the Strait of Hormuz is resolved. Global demand continues to grow, driven in large part by developing economies seeking higher standards of living, while current industry investment has remained relatively constrained as it has in recent years. These geopolitical events have reinforced the importance of energy security and have highlighted structural pressures throughout the global supply chain that suggest additional future demand. In my opinion, pre-war supply levels and strategic petroleum reserves have helped bridge the supply gap created by the Persian Gulf conflict, but they cannot serve as a long-term substitute for the upstream investment required to meet growing demand. Yet today, the forward strip continues to imply a market that eventually moves into surplus. Our view is different. We believe the industry will ultimately require higher commodity prices to incentivize the level of investment necessary to meet future growing demand. If investment continues to lag, the risk is not oversupply, but rather a tighter market than many currently anticipate. Now, regardless of whether our commodity outlook proves exactly right, Ring's strategy is designed, as you know, to succeed across commodity cycles. Our focus remains on disciplined capital allocation, capital efficiency, balance sheet improvement, and generating durable free cash flow for stockholders, no matter what the price environment. The second quarter provided a good example of that approach in action. While oil prices moved materially higher during the quarter, our hedge position limited our participation in a portion of that upside. It is important to remember that those hedges were established earlier in the year when the forward market reflected a significantly weaker commodity price outlook, and were intended to protect our cash flow, our 2026 development plan, and meet our debt reduction goals. Had oil prices not improved in the second quarter, we believe our strategy would have achieved our objectives, allowing us to execute our development program as planned. However, since oil prices were stronger during the quarter, we continued delivering on priorities within our control. The equity offering we completed gave us a balance sheet capacity to fund the acceleration of our development transition without losing focus on debt reduction. Rather than choosing between strengthening the balance sheet and investing in the highest return phase of our development plan, the timing of this raise allowed us to do both. Taken together, we believe these actions demonstrate the value of disciplined capital allocation and execution across commodity cycles. As part of our ongoing portfolio management, we are also continuing to evaluate select non-core assets that don't fit our long-term development plans. Any proceeds from potential dispositions and/or transactions will be directed towards further debt reduction consistent with our capital allocation priorities. Operationally, we drilled 7 wells and completed 4 wells during the quarter. In the Northwest Shelf, we drilled and completed 1 1.5-mile horizontal well and 1 1-mile horizontal well. In the Central Basin Platform, we drilled and completed 1 1.5-mile horizontal well in Andrews County and 1 1.5-mile horizontal well in Crane County. We drilled 3 additional 2-mile horizontal wells in Crane County that were not yet completed at quarter end. As of June 30th, we were also in the process of drilling 1 saltwater disposal well in Crane County. Now, what gives us confidence in our strategy is the growing consistency we're seeing across the asset base. Each well improves our understanding of spacing, landing zones, completion design, and development sequencing, strengthening our confidence in both inventory quality and development economics. Importantly, our focus today is no longer centered on proving the resource. Instead, it is increasingly about optimizing development, improving returns, maximizing the value of, and expanding our inventory. To help you understand what we mean by our focus on completing this transition, it is important for you to understand that we believe our undeveloped conventional assets are at a similar stage of evolution to what the broader industry experienced over the last decade, when advances in drilling and completion techniques unlocked significant value from the unconventional reservoirs in the Delaware and Midland basins. Before industry could drill and complete longer lateral wells and co-develop multiple benches, they had to invest in frac water storage ponds, centralized production facilities, and produce saltwater disposal wells and facilities. Earlier this year, as we began transitioning to longer lateral wells and co-development of our stacked pay areas, we required similar investments. Continuing these investments will allow us to improve capital efficiency, expand inventory depth, and enhance long-term returns. Some of these investments are summarized on slide 17 of our investor deck. So, what does all of this mean for 2026 and 2027? Last quarter, we shared that we were accelerating the investments to transition our operations to achieve the focus we just described. This quarter, we continued the acceleration of these important investments and are updating our 2026 guidance and providing initial guidance for 2027. For the second half of 26, we now expect oil sales volumes to range between 13,000 and 13,950 barrels of oil per day, for a midpoint guidance increase of approximately 2%. With respect to operating costs, we now expect LOE per barrel to range between $10 and $10.60 per BOE, for a midpoint guidance decrease of approximately 2%. With respect to capital spending, We now plan to spend between $80 million and $100 million during the last half of the year, bringing our total capital spending for the full year 2026 to between $158 million and $178 million. We believe this expansion is necessary for our transition to our development plan of improved capital efficiency that delivers superior economic returns, lower capital intensity, and higher cash flow generating potential than our historical performance. We also expect to fund this expanded plan primarily through operating cash flow, with our debt trending down to our leverage ratio goal of 1.25 times. Focusing on our initial guidance for 2027, we expect oil sales to range between 13,550 to 14,650 barrels of oil per day, and a BOE sales volume to range between 21,500 and 23,500 barrels of oil equivalent per day, for midpoint guidance growth of approximately 10% over estimated 2026 BOE sales. With respect to operating costs, we expect 2027 LOE per barrel to range between $9.80 and $10.60 per BOE, for a midpoint guidance decrease of approximately 1%, demonstrating our confidence in our team's historical focus on future operating cost reduction. Regarding 2027 capital spending, we are initially guiding to a range of $135 million to $165 million, for a midpoint reduction of approximately 10% compared to estimated 2026 capital spending. We believe this outlook reflects the quality of our asset base, the depth of our inventory, the benefits of the investments we've made positioning the company to deliver improved returns and sustainable growth in 2027 and beyond. With that, I'll turn the call over to Sonu to review our financial results, balance sheet, and outlook in greater detail. Sonu?
Thank you, Paul. I will focus my remarks on the quarter's financial results, continued balance sheet improvement, and the financial implications of the outlook Paul discussed earlier. Starting with production, second quarter total BOE sales volumes were within our guidance range, averaging 19,990 BOE per day, up from 19,351 BOE per day in the first quarter, a sequential increase of 3%. Oil sales volumes for the quarter averaged 12,683 barrels of oil per day. Realized pricing improved meaningfully during the quarter, driven primarily by stronger oil prices. Our overall realized price increased 36% to $57.55 per BOE, while realized oil pricing increased 38%. Natural gas pricing remained pressured by ongoing Permian takeaway and processing constraints, with our average natural gas differential to NYMEX at negative $8.14 per MCF. However, we have begun to see modest improvements following the startup of the Gulf Coast Connector expansion, and we expect additional relief as incremental takeaway and processing capacity comes online later this year. While we do not expect gas realizations to normalize overnight, the trajectory is moving in the right direction and should provide a more constructive pricing environment going forward. Revenue for the quarter totaled approximately $104.7 million, supported by average realized oil prices of approximately $95.45 per barrel. As Paul noted earlier, while crude oil prices strengthened significantly during the quarter, our hedge portfolio limited participation in a portion of that upside. Those hedges were established to protect cash flow and support balance sheet improvement and preserve financial flexibility during a period of commodity price uncertainty. As highlighted on slide 21 of our investor presentation, our focus on cost discipline continued to drive strong operating performance during the quarter. Second quarter LOE was $18.4 million compared to $18.1 million in the first quarter of 2026. On a per unit basis, LOE improved 3% sequentially to $10.12 per BOE, from $10.41 per BOE, while all-in cash costs declined 1% quarter-over-quarter to $21.59 per BOE. Cash G&A, which excludes share-based compensation and transaction-related costs, was $3.19 per BOE for the second quarter, compared to $3.40 per BOE in the first quarter of 2026, representing a 6% sequential improvement. The quarter also represented an important milestone in strengthening the balance sheet. We completed an underwritten public equity offering that generated approximately $65 million of net proceeds, which were used entirely to reduce revolver borrowings. As a result, liquidity increased to approximately $226 million. Outstanding borrowings declined to approximately $360 million, and leverage improved to approximately 1.7 times on a last quarter annualized basis. We remain fully compliant with all financial covenants and continue to target long-term leverage of less than 1.25 times. The progress we have made strengthening the balance sheet is what allows us to be more proactive in allocating capital across the business while remaining disciplined financially. As shown on slide 14 of our investor presentation, our capital allocation framework remains straightforward. Maintain a strong balance sheet, invest in high return opportunities, preserve optionality through commodity cycles. That framework guided our decisions during the quarter and remains central to how we are positioning the business for 2027 and beyond. Consistent with that approach, we increased second quarter capital expenditures to approximately $43.2 million to support the continued evolution of our development program toward co-development paths with longer laterals that will result in a more capital efficient operating model. This decision reflects our confidence in the quality of our inventory and the improving economics we see across our development program. As highlighted on slide 17 of our investor presentation, these infrastructure investments are expected to lower future development costs, improve well level returns, and enhance capital efficiency across future drilling programs. Based on our initial 2027 outlook shown on slide 19, which contemplates drilling approximately 20 to 30 new horizontal wells, we estimate these initiatives could reduce future drilling and completion costs by at least $7.5 million. This estimate assumes savings of approximately $50 to $100 per lateral foot. Moving to our hedge position, for the remainder of 2026, we currently have approximately 1.7 million barrels of oil hedged, or approximately 70% of our estimated oil sales based on the midpoint of updated guidance. Importantly, as illustrated on slide 20 of our investor presentation, approximately 30% of our expected oil production remains unhedged, and a significant portion of our hedged volumes are structured as collars with attractive call ceilings, allowing us to participate in higher commodity prices while continuing to protect cash flow and support our development program. We also have 2.4 BCF of natural gas hedged, or approximately 62% of our estimated natural gas sales based on the midpoint. For a quarterly breakout of our 2026 hedge positions, please see our earnings release and presentation, which includes the average price for each contract type. From my perspective, the most important financial takeaway is this: Ring is operating from a position of strength today, and we believe that position continues to get stronger. Over the last several quarters, we have materially improved our balance sheet, increased liquidity, and enhanced financial flexibility. At the same time, we continue to identify opportunities to improve the business and reduce costs. As highlighted on slide 16 of our investor presentation, the initiatives already implemented across our operations have reduced cash costs by approximately $1.50 per BOE, or roughly $10 million on an annualized basis. Importantly, we believe additional opportunities remain as we continue transitioning to more co-developed pads, longer laterals, and a more capital-efficient operating model. We believe the combination of a stronger balance sheet, improving capital efficiency, and a growing inventory of high return opportunities positions Ring to deliver attractive returns and create long-term value in 2027 and beyond. With that, I'll turn it back to Paul.
Thanks, Anu. As we've discussed throughout today's call, Ring remains focused on creating long-term shareholder value through disciplined capital allocation, operational execution, and financial discipline. We made significant progress strengthening our balance sheet this quarter. We also enhanced our hedging program, exposing future production to potentially higher commodity prices. Our drilling results continue to encourage our pursuit of transitioning to longer lateral horizontal wells and the co-development of our stacked multi-zone areas. The updated 2026 guidance and the initial 2027 outlook we provided today reflect the confidence we have in our asset base, operational momentum, and ability to continue improving capital efficiency and free cash flow generation. We believe Ring is stronger in every regard and better positioned today than it was at the beginning of the year. We remain committed to executing our strategy, strengthening the balance sheet, and creating long-term value for stockholders. With that, operator, we'll open the call for questions.
We will now begin the question and answer session. To ask a question, you may press star then one on your touch-tone phone. If you are using a speakerphone, please pick up your handset before pressing the keys. If at any time your question has been addressed and you would like to withdraw it, please press star then two. At this time, we will pause momentarily to assemble our roster. Our first question today comes from Jeff Robertson of Water Tower Research. Please go ahead.
Thank you. Good morning. Paul, in the past, you've talked about Ring's organic growth potential. And with the initial plan you're laying out for 2027, it looks like you're capitalizing on a lot of the work that the teams have done over the last couple of years as high grading that potential. Can you just talk about where you stand with respect to evaluating the asset base and identifying incremental drilling opportunities, maybe versus where you were at the beginning of 2026?
Sure. Yeah. Good morning, Jeff, and thanks. That's a good question. As you know, we have spent quite a bit of time over the last several years. So here we are. We're going into year 4, and we believe by the end of this year we will have also grown organically. So what do I mean by that? Having our geoscience and engineering teams and our land teams working together, evaluating the lands that we operate, looking for untapped or undeveloped opportunities on those, and just from an organic standpoint. And then going out and leasing additional lands that extend those areas because we know we have the confidence in the economics and the returns and all of that. We're also in the process of testing new zones. We've talked about that a little earlier, because in these stacked pay areas, we're not alone out here, and a lot of the things that we are doing today were pioneered by others. So, multiple bench development in the Midland and Delaware Basin is very similar to the stacked pays that we have in the Central Basin Platform. However, these stacked pays that we are pursuing are conventional in nature, so they're conventional rocks, so they have higher porosities and permeabilities. And in some of these areas where the porosities and permeabilities were not as economic due to older technologies, today with the application of horizontal drilling and especially longer lateral horizontal drilling, you can develop these resources, and then go into co-development where you're completing all of these stack pays all in the same operational initiative, significantly reduce the costs. And so, the real savings in being able to do that is investing in the infrastructure like we have. And so, getting back to your original question, we believe we see opportunities up and down the Central Basin Platform in all of the areas that we currently operate. We are continuing to evaluate extensions from those areas, and we're leasing, and we're looking for more opportunities. We believe by the end of the year, our portfolio will be significantly higher in terms of the inventory for us to prove. So over the last couple of